So the housing pendulum has swung from everything's going to be okay, great market, double digit appreciation is going to keep going, get that house, blah, 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 in January to 7 months going forward, and here come the foreclosures. That's a heck of a swing and a big change in such a little period of time. So, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is August the 8th. Randy Patrick here, putting the realism back in real estate. Hope everyone is doing well. Yes, a new logo on the screen. I'm doing some improvements to my channel, my operations, whatever. That's part of it right there. So you can certainly see got a new logo going. That's the 3D version. Lots of fun getting those things done. So today we're going to talk about that. We're going to talk about what's going on. And the reason why I wanted to cue this up today, because yeah, the foreclosures are coming, but I wanted to take a quick snapshot to sort of say, where have we come from, since January, and where are we today? And that's a really big change in perspective from what people are saying, what the market's doing, what the economists and analysts are saying or predicting. So we've gone from a completely different mindset in the beginning of the year, in January 2022, to where we are today. Obviously, we can take a look at that graph up there. This is from the end of the first quarter of this year. The darker shading is the metros and the regions that are overvalued. So you can certainly see that there's a lot of markets that are overvalued, and people are just having a tough time purchasing with all the changes that have gone on. Remember, the Dallas Fed calls out the market and says, we find signs of a brewing housing bubble. Okay, that's interesting. And then guess what? We've switched now from what really was no housing bubble, crash to, well, housing crash is coming. We're going to see some big changes here. Why are we seeing that? Numerous articles, videos, etc. It's coming in from everywhere now. It's not just me that are talking about this. We're talking about economists, housing analysts, etc. People who have good degrees and they're educated and they work for investment firms and stuff like that. I always joke people are flipping over to the dark side now. So pro housing. Well, now you can still be pro housing, but pro reduction in housing prices, of course. The key, though, is that no one wants to be wrong. So any given time during this housing market, people are going to err on the side of safety and err where the masses are going. No one wants to come out and actually make that sort of statement saying, hey, I think we're going to have some changes. Now, if you remember, I've had this channel for a while, and I've said the same thing. And I know I've taken pot shots here and there from people with their comments, and frankly, I don't care because I know it's going to happen. And guess what, guys? It's actually happening. So I've not veered from my original perspective on where things are going. Yeah, we had a little delay with COVID, but again, it's not just one thing that takes the housing market down. It's typically a number of things, right, that can contribute. And that's sort of where I'm looking at right now. We have more housing inventory. We're almost at 3 months worth. 6 months worth is a balanced marketplace. We're seeing price drops. We're seeing declines. We're seeing less bidding wars. New home inventory from the new builder segment is over 9 months now. So that's actually a record high pricing and now an oversupply. So they're actually above where they should be because housing prices out of control, people stop buying, etc. So now they got to pull back. So that exuberance has sort of gone on here, and we're in a different market than we were back 7 months ago, and we have to admit that right now. One of the big things that happened this past little while was that the Federal Reserve, they stopped. They were, of course, raising the interest rates, which affected the mortgage interest rates, reduced buying mortgage-backed securities. They had a plan as to how they're going to reduce doing that. They're going to start to sell off some of those mortgage-backed securities. And the Fed stated, as per Jerome Powell, and this has basically been in a lot of articles, and I had a video on that back about a month ago, the Fed said it's time to reset the housing market. They basically said those words: we need to reset the housing market because first-time home buyers can't buy homes. The average person, their median income, can't buy homes that are available in today's market. Why? Because home price appreciation has far outpaced wage growth. It's as simple as that. That's a known fact, and you can't really debate that. So when the Fed actually goes and says, we're going to reset the housing market, what does that mean? Well, to me, that means they're going to bring it down, which kind of is crashing the market, right? By the way, I had a Facebook Live yesterday, Sunday evening. If you want to go to my Facebook Housing Bubble 2 channel, I've got about a 90-minute video in much more detail than what I'm talking about today on this subject. So you can go check it out. I appreciate those that were on the video or on the live presentation, but you can go check it out now because once it's recorded, it sits there in Facebook. I know people are like, I'm not on Facebook, but it's free and it's a good spot to hold these type of things. So anyway, we're always going to have the pro-housing bubble people that are saying that there's no housing crash or there's no crisis coming up, so don't worry about things. Why? Because we have better loan programs here, i.e. tightening lending guidelines, better qualified borrowers, okay, supply and demand with low inventory, therefore prices will continue to rise. There's competition, all right, and we don't have speculation. That's one of the things that, a housing bubble by definition has an element of speculation. Well, guess what? Regards to better loan programs, we probably do, but we also have a new version of subprime called FHA, right? FHA is lower credit scores, lower down payment, higher debt to income ratios, and things like that. A lot of exceptions, so those are not as good or as qualified a borrower, but a lot of loans in the past couple of years were FHA-backed loans. As far as speculation, well, what have we heard the past couple of years? And I keep saying this, is the fact that when we see bidding wars for properties going 50K, 100K over list price, is the new buyer who's making that bid not speculating? Are they not speculating that it's going to appraise if they have a loan to grab on top of that property, or are they speculating that the numbers are still going to increase? They're going to cover their purchase with home price appreciation. So we actually have speculation. But people like to, the pro-housing people like to say speculations for the investor community. There's always speculation in the investor community, but we have it in the retail community as well too. I want to be clear, everybody understands that. All right, home price appreciation is constantly increasing. That's sort of the whole argument here. Homeowners in trouble will simply cash out and sell. Well, we know that's not going to happen, or it can't happen. The job market is great, employment market's great. Well, the past couple of weeks we're reading that we're seeing a big uptick in unemployment claims, and things are changing right now. So, believe that? I don't know. The spin on delinquencies, forbearance, foreclosure statistics, we can't get a handle on that. There's more out there that's being reported, and I believe there is a concerted effort to underreport or mislead the discussion regarding these statistics. The whole point is that buy, go ahead and pay, that's unaffordable, too bad. Housing bubble, we don't call it a housing bubble anymore. We call it an affordability crisis. That's the new word for that narrative. Don't worry about the foreclosures, forbearance, the distressed properties. Don't worry about them. Just focus over here. They want us to not think about what's happening down the road, but it's going to be very tough to ignore. Remember, this is a press release from the White House back, about a year and a half ago, when this coincided with an extension to the foreclosure and eviction moratorium. One of the things I want to point out there is that, the comment was today 1 in 5 renters is behind on rent. Again, 18 months ago, and just over 10 million homeowners are behind on mortgage payments. So that's what was happening back in COVID. So I can tell you that these, there's 10 million people, homeowners behind on mortgage payments. Are all those just disappearing overnight with all the programs that we have out there? Did forbearance help everybody? Did loan mods help everybody? Probably not. So there's your kind of key number there that nobody really picked up on, which is I found kind of interesting. That was kind of ignored. But we keep going on. And also, you talk about forbearance. Well, mortgage companies tell homeowners to cough up large sums of loan after loan forbearance. It's a fiasco is what it is. And the reason it's that because the narrative and the press releases were all, hey, we're going to solve a problem. COVID's here, the pandemic's here. Call your mortgage company. They're going to give you forbearance, blah, blah, blah. That was discussed openly, but maybe the terms and conditions weren't quite explained to every homeowner. And homeowners now are being shocked when they're told pay up. Oh, I don't have the money. Okay, well, we got to put you in one of our loss mitigation programs. Okay, well, I can't afford that, or I can't handle the loan amount. Okay, well, then you're going to fall into the foreclosure bucket. Okay, so this is how stuff plays out. This is why we're going to have, all these little things add up to major housing issues. Guess what? I just looked on CNBC today. There's discussion points. The past 2 years have been an artificial housing market. That's right, because you have a market that's being constrained with no distressed property coming on to add much needed inventory and lower price inventory, and therefore the needs of the public were changing with respect to working from home or relocating to different types of areas. The market was constrained, competition was there. We had bidding wars, everything went up quicker than ever, and that's why where we are today. So people are saying now it was an artificial housing market, it wasn't a natural market. All right, well, this guy, I talked about this a couple of videos ago, senior economist saying a perfect storm is brewing for a 2008 style crash. It's going to happen, right? Basically what he's saying is that he expects that the median U.S. home prices will drop by about 25% when all is said and done, which I think is actually kind of conservative. And basically he was saying that's just about how much the last housing crisis, went up and down based on the Case-Shiller data. So if you want to go a little farther on that, we can take a look and go, you know what, he was pretty clear on that, because on the Case-Shiller side, from the blended national averages, that number one red bubble in the middle there shows that the from the 2006 peak to the 2012 trough was about a 27.4% decline. Now, yes, some housing markets had greater declines. Some didn't have as much declines, but nationally across the board, that's what it was. So basically what he's saying is that all the things that are happening now are similar and pointing to just what happened that we saw just before and during the 2008 financial crisis. So we are seeing this play out again. Real estate is cyclical, shouldn't surprise anybody, right? I spoke about this as well too. Foreclosure starts up more than 440%. All right, well, guess what? That's important. Yeah, coming from a down year, we can see that things are going to be up. They could be up 50%, 100%, but 440%, we know they're on their way. That's the point to this video, okay? Look, this came out today on CNBC as well. Don't expect recovery in housing anytime soon. So what the economists and analysts are saying is that we have a lot of problems coming up here. So don't just think that maybe a slight dip in mortgage rates, because they went down recently last week a little bit from their record highs, or the highs over the past few months. Don't think that that's suddenly going to spur the economy and the housing market and everything's going to be honky-dory. It's not. We're seeing the fractures, we're seeing the shift, we're seeing that things have actually gone above the peak and are sliding down now. It will accelerate. All right. Expect foreclosure spike in the coming months. So guess what? We're going to see more foreclosures. We're already seeing more filings, more things going to auctions. There'll be a lot of backlog being cleaned up. But the point, though, is that now this is being talked about. So take us back to January, first week of January. No one's even speaking about this. That's kind of my position here. No one's talking about a foreclosure spike or things that are coming. They're talking about how we're going to have a great year and expect, keep on expecting that double-digit appreciation throughout the whole year into 2023. And, nothing seems to be in the way of changing that. Well, guess what? We saw how the Fed tightened. We saw how they changed their policies, and now they're trying to curb inflation with the raise of interest rates. That's definitely affecting housing. That's going to permeate its way all the way down to where we are today. Once again, servicers now, the lenders, banks, and the servicing companies are bracing for a rise in foreclosure activity. They're going to have to staff up. And again, whenever we see statistics out here, I always take them with a grain of salt. Whatever we see here, realize that they're always underreported, underestimated, because they're just samples. The real world scenario will always be much greater than what we talk about here. But again, this is more and more of these articles. And here I found this one today. This is interesting, and the reason being, well, it's talking about the not so surprising resurgence of home equity lending. So what goes on? So you got a great mortgage, but you want to do a cash out refi and tap into all that equity you've earned over the past couple of years. Well, you know what? Rates are too high. So guess what? You're not going to do a traditional cash out refi. But what you can do, you can go to your local bank or their provider or credit union, whoever you keep your money with, and you can take out a HELOC, home equity line of credit, which is, it's almost like it's a revolving line of credit where you can take money out, and it's not going to affect your first mortgage. Okay, as long as you got the loan to value on your first mortgage that gives you that room, you can take a HELOC and you can pull money out and play. They don't care what you do with it. Well, in theory, you're supposed to be making home improvements, but the point, though, is that there's no way to track that. So people will start to do this. So obviously, when things are great, the cash out refis come into play, and then when the cash out refis aren't as attractive because interest rates rise, then guess what we have here? We go to HELOCs, because HELOCs are a little different, their rate structure is a little different, and you don't have to go through the whole loan process and repackage your first mortgage. You're just saying, I want to play with a little bit of equity that I have in the property. So different ball game, but the resurgence to me shows that people are going, I'm going to tap I'm going to tap this, all right? And when they do that, now they just increase what's owed on the property. So when there are subtle changes in home price values, i.e. they drop down, suddenly you become at, over leveraged or underwater, which becomes a problem. So this will be the sort of final nail in the coffin where things will change in the housing market. So people who are, couldn't sell or maybe didn't want to sell, they're still going to play with the virtual, and I call it virtual money, because again, we can all go to Zillow, we can all put in your home address and go, ooh, my Zestimate is up to here. We all think our properties are worth more than our neighbors for various reasons, and you want that high Zillow estimate. So that's the money you're going to, that's your virtual play money that you can utilize, out of your home with all this equity. And again, but that equity can change immediately or the next day. So please be aware of that. Back in the last housing crisis, everyone blamed subprime for the mortgage meltdown. That did cause the mortgage meltdown originally, and that was the starting point. But the real casualties, the real issues that pushed us over the edge were cash out refis. Okay, so that people weren't just doing rate and term, they were doing cash out, pulling money out. And yes, there was a significant time for a couple of years where people were doing HELOCs and pulling big money out. Those HELOCs, those interest-only HELOCs, were good for 10 years. And then after the 10 years, it's like, guess what? We got to start paying that. If you can't pay it all back, you're now in a fixed-rate loan program on that HELOC. So things do change, but HELOCs are the easier way to get access to your equity, which doesn't always bode well for the housing market. So that's just, why I want to go through this, because, we've gone through such a big swing. It's been amazing going from, everything is going to be great in January. We have no idea what's happening. How can I put it? Like, the economy wasn't quite in the situation it is now, but there were signs there. Fed suddenly changes rates, housing dynamic changes. Now things are going forward. Backlog of foreclosures coming. People looking at alternative ways. Now analysts have gone from rah, rah, rah to, ooh, we got some problems here. So again, the point is, amazing what can change in a matter of about half a year. Look at that. All right. Why am I talking about this? Well, guess what? Here, this is you've probably seen this example before, but this is what happens in these type of markets. So, if we can get deals on homes where we're getting 50% off on the mortgage or on what's owed, the final judgment number, this is a foreclosure property, we're creating some equity, which is going to give us some opportunity. So you can see that, my investor client who did this, we got it for, 172.5, and they sold it after they fixed it for 420. All right. So I can tell you they didn't spend $200,000 on their rehab. All right. They made some pretty good money on this. So these are deals that are there, and you need to go find these deals, and that's where the opportunities are. There will be more of them coming right now. They're here now. You just got to go look for them, and more are coming as the foreclosures are kicking up. You just saw some quick slides there showing that foreclosures are coming. There's more filing going on. Expect September to be a very busy month for foreclosure filings. The filings do run through usually three cycles of filing volume per year. I kind of figured out when those were, so that's going to happen in the fall, and that's where it's going to go on in the next little while. So be ready for it. But again, this is an example of what you can do if you're in the real estate business and you're thinking about how to mess with this marketplace. What I'm looking for, obviously, it's a new logo. I've told people I'm moving to my new Foreclosure Fortunes program, but right now I'm looking for real estate agents in Florida who want to join my firm. I also want to open up other metros and specific metros across the country where we're going to have other housing crisis issues. I'm also looking for investor buyers. Now, what I'm not looking for is just, hey, I want to find one property. You know what? You can talk to any real estate agent for that. I'm looking for people who are going to do multiple properties and want to do a little bit of damage to the marketplace, and that's who I personally want to partner with. I'm looking for private lending partners. So again, same thing, whether it's investor buyers or private lending partners, we're going to have a lot of distressed properties to review and look at. I also like to do a syndication or a little equity fund where we're building a portfolio where cash flow, rental, etc. And of course, how are we doing this? We're doing this with distressed properties that we're picking up on the best price possible. That's kind of what I'm looking for. Also for you guys, my short sale program is being retired. So it's limited time, like very limited time to get it. Last little bit here. New foreclosure programs will be the replacement. It includes everything from the previous. So if you get it today, you're not losing anything. You just get better pricing and more benefits because things will change with my new program. It's broken into different modules. It's not bundled. The net price will be net increase when everything is all said and done, just the way it has to be. Current members will transition and keep current benefits. Hit me up at randy@luxuryshortsales.com. if you want more information. I've reached out to a lot of people. Let's get connected today or tomorrow. All right. So there you go, guys. Lots happening here. A new logo, as I said. Reach out to me, Randy at luxuryshortsales.com. Connect for whatever you want to do in real estate. But the point of today's video was look at the changes that have happened in such a short period of time. We've gone from, no way and until hell freezes over that we'll find, we'll get to a housing bubble burst or a housing crash to people are openly talking about it. And now we've gone from, no to here come the foreclosures, better get ready. There you go. So once again, everybody, thanks for the views, likes, comments. Please share the video to your family and friends. If you're not a subscriber, please subscribe. We'll look forward to speaking with you in a couple of days.